You guys ready? Yep. Okay. Good morning, everyone, and welcome to the investment meeting for April 2012. Let me turn it over to the chair.
Good morning, everybody. Let's go around room. Andy Schaefer, representing the police department.
Barry Dennis, SIS.
Dan Torelli, PBA. Joe Alejandro, PBA.
Joe Strong, PBA.
Chris McGrath, PBA.
Bob Daniel, SBA.
Kevin Letty from the OBA. Chris Monahan, CEA.
Bill McNeely, DEA.
Karen Paxtis, DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Seema Ibrahim, Controller's Office.
Thad T, Controller's Office.
Larry Schloss, Controller's Office.
Ranjit Nagaswamy, Mayor's Office.
Janice Emery, Office of Finance.
Bob Saskistat Pension Fund.
Kevin Holleran, Police Pension Fund.
Alex Donier, Controller's Office. Neil Messing, Controller's Office.
Katrina Schofield, Controller's Office.
Okay, with that, we'll turn it over to Larry.
Thank you. Everybody have their color copy? Good to go? Okay. Pretty straightforward month, actually. I'm going to very rapidly go through the economy. Good news is it's up. Page 6 is the page to look at, I guess. It's the weekly unemployment claims. Again, they continue to drift down. That's a good thing. Unemployment rate is stuck, but it continues to drift down.
House prices stable.
And if you look at, let's go to 11. The blue line is housing prices. Thank you, Joe. Continues to drift down. At some point it's bottoming, maybe now. But it's the single thing holding things back. Although if you go to 13, you can see new home starts are again trickling up, but it's not enough to start a construction boom by any means. And it is the overhang on the jobs problem. Again, just thumping through here pretty quickly. If you go to page 22 at the VIX, recall that the ECB flooded the European market with 3-year loans, and that made everybody feel good. And it's risk back on since probably mid-December. So you can see the VIX has calmed down back to probably the lowest levels in a while. Similarly, if you look at the yield curve, which is the white line on page 23, people started readjusting their books pretty quickly because risk was on, so you get out of very safe things like treasuries. So again, you can see the white line is now above where it was at the end of the year. My guess is it'll drift down again when the Fed tries to take control again of the yield curve. Risk on manifests itself a little bit on page 25. The red line on top is the high yield spread to investment grade. And again, people pile into risk, you get the spread coming back down. We bought a bunch of high yield bonds. We've had a bunch of high yield bonds. We bought some more before this happened. So I think we're okay with our high yield portfolio. If you go to page 30, you can see that generally equities have rallied again since the ECB cleaned up the euro, or Europe's short-term financing issues. Europe is not fixed, but the funding of Europe is probably fixed. Portugal, Spain still have their longer-term funding issues. We'll get to that another day, perhaps. That said, if you look on page 32, this is as of the end of February. The police pension funds at north of $25 billion again. I think it's at an all-time high, and I think March probably added to it. So if you look at it on page 33, for the 10 years is a pretty nice trend, despite the volatility. So if you quickly jump, let's jump to page 38. On 38, you can see the markets in February. So again, the far left-hand column, the U.S. markets are up about 4%, international probably 5 or 6. And if you go all the way down to the sort of the 5 or 6 on the bottom, the high yield market was up 2. So all that led to good things happening, which you can see good things happening being page 39. So we're up about 3% in the month of February. So for the fiscal year to date, we're back in positive territory, a little less than 2%. Again, I think we added a little bit in March, but we'll see because it was a little bumpy in the middle of March. If we go backward now to an asset allocation snapshot on page 36, we're kind of getting into these new adjusted policy benchmarks. Remember, we have some parking places for things that are under-allocated, like real estate, for instance. So you can see, again, these are the new ranges adjusted for the parking places, and everything's pretty much where it's supposed to be. We're probably out of the range in tips, which we could talk about at a later time. Optimistic fixed income is getting funded as we speak. So a couple of the newer managers have finally gotten their documents lined up, and they'll be funding in the next, the first funding was last month?
It was within the last month and a half, and we continue to fund now.
Yeah, so that one will take care of itself, and it kind of leads to a little bit of over-allocation on a dollar basis into high yield. So if you look on page 7, I'm sorry, 37, sorry. And you look at these numbers, if you start at the very bottom, you see that we've got about 68% in equities and 32%, let's call it, in fixed income. Again, we're kind of leaning into equities and out of fixed income. But when you add in these adjusted policy targets, which is really the right thing to be looking at, you see that we're leaning into high yield bonds, which again is the right thing to be doing right now, and that's mostly because we're under allocated in the opportunistic fixed income. The rest is all pretty straightforward. So we had a good February. We'll probably have a positive March. I'm not sure if April just started. So hopefully the markets will help us for the rest of the fiscal year. So I guess June 30th is the number that matters, and we're out of the danger zone until someone else puts another danger light in front of us. The rest are all the manager-by-manager stuff, and people are, again, they're making money, so they're getting closer to or above their benchmark, so there's less red in the last month. Seema, is there anything you want to talk about in equities?
No.
Martin? Fixed income, no? Barry?
I can mention one thing.
Yeah.
So, as people may have seen today in the, actually it was in the newspaper, the New York Post, there was an article about a beef processing company called AFA, which is in the portfolio of police and actually the balance of the retirement system. It's owned by UKIPA, the Corporate Initiatives Fund. The company did file for bankruptcy. It's a company that they've been working on for a little while. The reason I bring it up, A, it was in the paper today, and B, if you look at it just from an exposure standpoint, so, and again, this is out there, if we look at it, based on the commitment that police have made, their actual exposure to this company is $4 million, and the company has filed for bankruptcy, and for the moment, it doesn't look as though there's going to be any recovery. And if people want, I brought the article so people could look at it, but that is a company that was mentioned today in the paper.
Yvonne, anything in real estate?
No.
Okay. Any other questions of the monthly? Okay.
I have a quick question, Larry.
Yeah.
So these returns are gross of fees or net of fees that you're seeing on a monthly basis?
These are net. These are net.
So all the returns that BNY Mellon is providing,
These returns are net. These returns for the managers are gross.
the manager returns are gross? So I think we talked about this at the fire meeting a few weeks ago. Since we're seeing manager returns gross of fees, would it be possible to start to see a report of what our asset manager fees are and how they stack up to our peers? So, Larry?
I will try to get that report for you. We have a very fundamental issue with a custodian being unable to give us net of fees. Having talked to the custodian, I would say since the second day I got here, and I've been here 2+ years, and I can't get him to do it net of fees. It's boggles my mind as to why we can't get the information. Maybe I can pass it over to someone like Martin, who's been here longer. Martin, why can't we get net of fees out of the custodian?
Yeah, part of the issue is how the fees, the way the custodian operates is that they process transactions. And fees are transactions. The way we pay the fees, because of corpus funding, is when we approve it, when the manager submits the fee and we approve it, the fee comes out of the assets of the portfolio. That is categorized by Bank of New York. And part of the issue is categorizing things correctly, number one. So if the custodian doesn't categorize things properly, you end up having to go back to each of the individual accounts to make sure they're categorized properly. And I'm talking about on the custodian level. And number two, you have the other issue of timing, which is you're assuming that we pay fees, or fees are submitted, let's say, for the quarter ending a few days ago. Fees are submitted and paid immediately and then reported immediately. The reality is there's a lag. And sometimes there's a lag such that there are several fees in a row that are paid, such that you end up showing performance in the short term that affects several quarters worth of fees. That's for us and the bank to work out as far as the coding and to make sure that the fees are paid and processed promptly and dealt with with Bank of New York in the appropriate way. This is not, from what we've looked at, unusual, but we do have, in order to produce a net of fees result, we would have to effectively use blunt force, which is to say, here are the gross returns, here are our version and our estimate of what the fees are. We know what the fees are in basis points, and therefore this minus this equals your net fees.
So Barry, you sit on a number of investment committees. I'm sorry, speak up, please. I'm asking Barry Dennis, who obviously sits on a lot of investment committees, if this is a common problem with BONY. And second question, does SIS do any after-fee reporting? Do you have that capability?
It's exactly as Martin says, and it's not just BONY, it's every custodian. To create after-fee returns, we do the brute force. So we take a basis point annual and apply it quarterly, reduction in return.
So do you then provide clients with the fee the after-fee returns and the comparison to peers?
We provide a net of fee return, but we don't compare it because everybody else is giving a gross return. So the comparison should be gross to gross.
That said, we're working on benchmarking us to the other funds. So if everyone has the same information, it doesn't matter. So we're trying to compare ourselves through their other funds, CAFRs, which are net fees. Because all the accruing and allocating takes itself out at some point.
Can I ask, is this, and I know Barry said it, this seems to be common amongst many custodians, but is this also as a part of the contracting process? Are all the managers required to submit their fees in a particular period of time when a quarter ends, or are they just whenever they do the fees and then you would have to do this later,
So the short answer is we do have a process in place. The managers are required to submit the fees in short order after the quarter as soon as they get the results. But remember, they're not getting the March results, for instance, the most recent time period, until later or towards the end of April. And so we're not going to first get the calculation from them until the end of April or early May. So there's just a built-in monthly delay just from that. Then, of course, there's the review of that. There are differences in calculations, and we often find either errors or omissions in the way the calculations, and quite frankly, the people who, at the firms who calculate the fees, there's a lot of turnover. They're typically junior accountants who do the calculations of the fees at managers. And so we often find errors in that need to be addressed in conversations with them. So it does take some time. And so there is a bit of a delay in that. As far as the contracting process, no, once we get the contract in place, the rules as far as calculating the basis points, applying it to the market value, are what they are. The reality is having hundreds of accounts doesn't help, but you will have every quarter, because of turnover and because of complexities, differences and errors that come up that simply take time to adjust.
Now, just to add to the complexity, the private markets, the private equity and real estate are meshed. Because they send us a quarterly bill, it's all baked in the returns. And those are net fees, but we're into gross fees.
Same with hedge funds, those are all net.
Which is good, because those would be the
High fee.
Highest
well,
fees.
the high fees, but also those that are on performance-based fees.
But the rest should be very simple, right, as a result.
That's why brute force should be okay.
And part of the difference between this, what seems to be simple, is because in the hedge fund, private equity, real estate, and opportunistic fixed income world, it is the manager of the GP that has the authority to do that calculation, and the fund then gets audited and then gets reviewed on a yearly basis for looking at whether the fees were applied correctly. In this case, it's up to the managers to send to us, and so you do not have the manager simply having the ability to say, okay, here are the fees, I'm deducting it automatically. It must go through a process where we approve that and then send it to Bank of New York, and that's where you get a lot of differences.
When we first designed this new report, I guess the first new report that looked like this was off of the blue sheets. So that was probably June 2010. We were designing it, I said, well, why don't we just estimate the fees? So at least you get an estimate as to where you are net. And Boney and everybody else said, that's really, it's brute force. Be careful what you introduce then, because if you start with things that are estimates, before you know it, you've probably made a mistake along the way. So we backed off of putting in sort of a rough justice, just assume, if you will, small cap is, 35, 40 bips, large cap is less, call it 20, 25 bips, and just deduct it. And the answer was, now you've made up all these numbers. So rather than make up numbers, we just left them all comparable gross, because it's comparable to, for instance, the way we benchmark things on a quarterly basis. When you look at the TUX rankings and all that, it's all gross. Everyone in the pension world is looking at the same numbers. So,
But it also, I'm a neophyte at that, but wouldn't the issue then be how much the contract is worth in another fund, a comparable fund? So you may be getting 25 bips here, someone else may be getting hit with 35 bips over there, so it's not a real true apples-to-apples comparison.
right. That's why everyone reports to TUX gross. So everyone's equally inaccurate. So then the question is, all right, well, how about if you do some benchmarking work and really, really get the numbers, which we're in the process of doing. We have those numbers, and we're sort of in the middle of the pack, fully costed for all the asset classes. And again, those numbers are all based on benchmarking surveys based on their CAFRs, which are net. So we feel better about that, and we're working on it now. But again, I'd rather have this report be all net, because everyone looks at it, this is net, 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 net. And the answer is that's just not going to happen the way it's all set up with all the managers. We could do a one line and tell you, well, by the way, the average fee on the fund is X, and just take it off of this. But again, now which would be right, because we can estimate what the fee is. The fee for public equity is in public debt, because again, you've got private equity, you've got real estate, you've got hedge funds. And just take it off of this, if people think that's useful.
Well, I have a suggestion. Perhaps you can do a combination of what you've been working so long on trying to get the data to be exact by doing what Barry's talking about, making an adjustment on a quarterly basis, and then when the actual fees come in, then just adjust it to the actual. So initially, there will be some bit of a slippage until you get the actual invoices, but then once you do, you would know what the actual fees are. So perhaps you can explore that as an option. And I think the second thing that I'm asking is, can there be some sort of fee benchmarking, not just across the New York City systems, but I know that certain consulting firms provide industry standard fee benchmarking for each asset class. So I know Greenwich Associates, which we probably participate in annual surveys, does publish to its research partners what other plans are paying, so we could use that, and it's free to us as a research partner. And I think other consulting firms that the other systems may work with also do similar benchmarking reports. So perhaps we could explore some sort of an annual fee benchmarking report to the board going forward.
Amateur.
We have a benchmarking study that we're working on.
It's a little, but as a trustee, Larry, I would vastly prefer an independent.
No, it's not ours. We're not doing it. We have an outside study that we're working on, loading our data into their benchmarking system to get the output out just the way you'd like.
I see. Will that be risk adjusted and size adjusted? So you know my reaction to the TUX, which is it's supposed to.
No, it's not. It won't be risk adjusted. It's just fees. It'd be by asset class, large cap, small cap.
Just a fee benchmark, not a performance benchmark. So I'm asking for the
Fees. I know where you're going with this. I would like to point out that, because I think we've had briefly this conversation with fire. When we talk
And
about
NYSERS.
Right. When we talk about the fire fees, understand that we're talking about really one pool of the New York City system. So fire, while they are an $8 billion pension fund and police is a $25 billion pension fund, we're really paying the fees overall on $120 billion because everyone is being counted and used to calculate the fees. You're getting the benefit of all the other retirement systems, as are the other, even smaller retirement systems. So
I understand the scale effects. I guess I'm asking a different question. It is very... There's some point to looking at the tax information. It tells us how we're doing versus every pension fund out there. But given our scale and given our policy portfolio, the far better comparison, which other consultants are doing for us on the other boards, is to give us, Barry, a more comparable peer universe. And the peer universes are simply adjusted by size and asset allocation. And then going into the asset class level, it really gives us a snapshot of how we're doing versus our policy portfolio by asset class. And it takes away all these fee issues when you're looking at it by asset class, because most people report the various asset classes the same way. Does SIS do anything like that?
Oh, sure. You tell us what size cutoff you want.
Well, actually, I looked to your recommendation on that, but it would be it's much more useful than what we are seeing from TUX. And on the other boards, we have seen the first report from Calvin on NYSERS, and we are now going to start seeing it on a quarterly basis. So could I ask that if you could look at year-end returns and
I would
give us...
say 10 billion and up.
Yep.
To get a robust universe,
Yep.
you have to go down that low.
Agreed, yeah.
Randy, just to be clear, the TUX numbers are 10 billion and up.
But they're not adjusted for policy.
No, they're unadjusted for policy,
Right.
but the sample you've been looking at is the right sample.
On scale.
Yeah.
Yeah, not on risk.
Not on risk.
Right. So, and who are you, is there a reason the boards are not more aware of this fee study that BAM is doing? Can you share more with us?
Maybe I could do that in executive session.
Sure.
So the request is to get a little more thorough analysis of...
Our relative performance in a peer group, but also not just returns, information ratios, Sharpe ratios, to look at what risks are we taking relative to our peers, so how much are we getting paid relative to our peers for the risks that we are taking, and a much better peer group comparison so that we can separate. Essentially, what the tax return shows us is very difficult to separate what the board's primary role is and what BAM's role is. So let me explain. The board looks at recommendations by the consultant and BAM, and we pick the policy portfolio. We pick the policy portfolio so that it gives us the best chance of getting to the actuarial investment rate or a certain level of risk. We own that. We own that with BAM, but the board makes that decision. BAM works with consultants on manager selection. And yes, we vet the managers, but the vast majority of the time, 99%, 95%, we select from BAM's recommendations. So BAM owns performance relative to the policy portfolio. So there are two levels. So think of the policy portfolio as being the beta, and BAM owns the alpha. And something like the report I'm looking at, and we're asking for, would help us start understanding where the value is being added. Are we doing a better job in equities or in private equity or in real estate? Are we taking more risks relative to peers? Are we simply getting a higher return because we're taking more risk? Which, that's not value added, that's just taking more risk. Or understanding that. Or are we taking less risk? Are we systematically taking more risk in equities than we are in fixed income, or vice versa? So this report, would you agree with everything I've just said? Would help us understand those types of nuances.
We can help with that.
Great.
Patty, I would just add that I don't disagree with anything Ron has put on the record, but I would only ask that if you're going to do a report like this, that you also provide a memo to all the trustees explaining the methodology and what the actual result will be that we're seeking with this type of report, so that we could all be on the same common basis of knowledge here.
Okay, certainly.
Thank you.
The last question was, Barry, when does SIS do its next round of return estimates, and is that a May process for you all?
Yes, early May.
So,
I think it's scheduled for May 1st next.
So would you come to us in the May or the June meetings? I guess June, probably?
June.
Okay, with an update on our own plan and our policy?
Certainly.
Okay.
Is that it?
I think that's it.
Okay, we need a motion to exit the public
Motion to
session.
leave executive session and, public session and go into executive session.
Second?
Second.
Okay. We'll take